special discount for this class. If you click on the link for the class, you're gonna get it very, very low. And in that class, we teach you everything step by step. All those indicators, all those technical that you need to know in order for you to make money. So welcome to everybody. Let's just get there. We're gonna talk about some top candlestick pattern for winning trade. There are plenty of candles, plenty of things that you can use. But today I'm gonna give you the main thing, as I've been promised you, the main thing that you can use in a short for you to be able to trade. But it's not gonna be everything. It's gonna be some of them because you have to take the class in order for you to know more about it. Now, we have some candlestick. Those are the top I'm gonna give you. The first one we're gonna see today is what we call bullish engulfing pattern. What is a bullish engulfing? A bullish engulfing is a large bullish green. Is a large bullish green candle. So as you can see there, we have two candles here. We have the red candle and we have the green candle. And the green call the bullish and the red call the bearish. You know, the stock market, we have what you call bearish and we have what you call bullish. So bullish means whenever the stock is going up, that's a green candle. And the bearish candles means is a red one whenever the stock is going down. So those are the different. Bearish means stock. So bearish means stock gonna go down. And bullish means stocks will go, bullish means stock going up. So one of the best candle that's show you a very strong bullish, we call it engulfing. So why they call this green candles engulfing? Because it's been covered the previous red candle. Because you see this one is a red candle. So it's a large bullish green candle completely engulf the previous one, which is the previous red. So you see, and it closed lower. So therefore, this one will help you to know more about it. So this candle is engulf the great candle. So it's open low, that means it's open lower, and it's closed higher. That's what it means. It's a red candle left than bearish candle. So means this candle, you see this, the big candle, it's open and then it's closed higher. And it's engulf the previous one. You see, this one is small, red, and the big one, which is the green one, is engulf. So it's a bullish candle closed above the previous candle open. The length of the bullish candles engulf the previous red candles, is engulf it. So whenever you see a big green candle in a short, that means it has a chance for the stock going higher, because this one is a red one, small, but the green one is open there in the bottom and closed at the top, and it's closed higher. This one, you see, it's closed higher. So it closed there. So whenever it's closed higher and it's engulf, that means it's bigger or cover the small one, stock has a chance to move higher. It has a chance to go higher and higher. But remember, it has to be combined with other indicators. Those things that you have to know when you take class, when you learn it. But I'll just give you a glimpse. I'll just give you an idea about how to use candle, what is the candle, what it means, what they can do. So the first candle is a engulfing candle. So the engulfing candle means is cover the previous one. So it is a large bullish green candle completely engulf the previous one. Whenever you see this big candle, it's cover the previous one. In a short, if you have a short, you got a big candle like that, the big one. That's been stock has a chance to move higher. That's the first candle. Remember, I told you we're gonna teach you about candles today. Give you an idea because sometimes people see candles, they don't know what they mean, or people see them, they understand. But today I'm just give you a better idea about. Now, we're gonna talk about this next one. The next one, remember, we talk about the engulfing. That was the first one, the engulfing. We call this one engulf. So engulfing candle. So we're going to talk about the next one. The next candle, very powerful, is called a hammer candle. A hammer. Those are the hammer. So what is a hammer candle? A hammer candle, as you can see there, is a small body with a long lower wick. We call that wick. So we call that wick. As you can see, this is a hammer. We call this bottom wick. So whenever you see a wick like that, what does it mean? Does it mean like buyer? So it was a bearish candle. But what happens now, we call that the buyer just come up, they push the price. We call it push the price. So that was it creates empty wick or empty body. This means this one was a body full. It was a full red candle. It was a candle like this one. You see, this one is full. So now, whenever the buyer come up and push the price up, it creates an empty body, and it makes this one a hammer. You see, it looks like a hammer because what happened? A hammer candle is a key short pattern in technical analysis that signals a partial reversal in a downtrend. So whenever you see a downtrend, and after a series of downtrends, so that means stock been going down, and you see this hammer candle come up in the bottom, as you can tell as a support, that means stock have a chance to go higher. So after a series of series of the red candles, and we have the hammer candle come up down, we have a chance for the stock to move down. That's why you see after this green candle, and the stock moving higher. You see, next moving green candle. So as I just told you, is like an empty body. You see, it was a red candle like those. We can see that it was a red candle like this one. It was a red candle. So now what happened? Buyer just come up. Whenever the buyer come up, they push the price up. They push the price up. And now it creates an empty wick. That's why we call it wick. We call this wick. And then now stock has been closed above. So you see, it closed there. So create empty body and it closed at the top. So as the expression says, a small body with a long lower wick and little or no upper wick. So that means it can be no low upper like this one. That means maybe not have any wick, or it can have an empty wick. Appears after downtrend indicating strong buying pressure. So anytime you see that, is a buyer pressure. So that means buyer come up and push the price up. So it gets its name. It's like a hammer, you see, as you can see there. So the second best candle that you can identify after engulfing, we call it hammer. So whenever you see those two candles, first thing you see the big green candle like that after cover the previous red, you have a chance for the stock to move higher. And also the second thing, whenever you see the hammer like this, and then like this candle, the stock has a chance to move higher. Next time it's gonna go high, as you can see there. But that means the buyer come up and push the price up, and it closes at the top, as you can see, and it creates empty body, so moving higher. So those are the second. So remember that anytime you see those two candles, stock have a chance to go higher, but it has to be combined by others indicators that you have to know about. When you take class, when you study, you know what's need to be combined with that. But I'm just told you we're gonna teach about candlestick today. So the third one I'm gonna show you called Morning Star. That's a great candle also. I'm just giving you the name. The morning star, what is a morning star? The morning star is like a 3 candles pattern. As you can see, there's 3 candles, 1, 2, and 3. So whenever you can identify those 3 candles in a short, you have a chance for the stock to go high. Today, we just teach you about bullish. So I'm just teaching you all the bullish candlestick, most of them. And next time, we're going to do a live video. I'm going to teach you about the bearish. And then from there, we will know. Now, don't forget, we have the class that we teach you all those candlestick, all those indicators, how to trade to make profit. Click on the link. I will put the link down there for you, and I will share it for you so you can click. And for those people that's taking this, that's watching this live webinar, you have a good discount with this class because it's very important. Now, we have a large bearish candle. We call that bearish. This is a large bearish candle. That's it. That's what the morning star called. And we have a small body candle. That's the second one. Remember, I told you it's come up with three pattern. And we have a large bullish closing above the midpoint. So that means whenever the next big candle, it closes above the midpoint. This is the midpoint. That's a small green bullish candle. So whenever the next candle is closed above it, so it closed above this one. That means it's closed, you see? Because this one opened there and it closed there. So you see, it opened down there and it closed here. So this one now, the next one is open here, is open and it's closed. It's closed higher. So it's closed there. So that means this candle is closed higher than the previous one. That's what it means. So whenever the next candle closes above higher than the previous one, which is this one is the previous one, that means stock has a chance to go. So the first candle, not really enough. It can be enough for you to buy because whenever you see this small candle sitting at the support, I will teach you about the support. If you need to know about support and resistance, take the class, you will know more about it. So whenever this candle is sitting there at the resistance, it's enough for you, you can take a trade. But the better way to take the chance to take the trade, you have to wait for a confirmation. You have to wait for the confirmation. It has to be confirmed first. How is it going to be confirmed? By the next green, this candle. So this candle has to be closed, like you see this, closed above this one. So whenever this candle is closed above the previous one, stock has a chance to move higher. That's why we call it morning star. So morning star is a 3 candle pattern. As soon as you can identify this in a short, you can take a trade, but it has to be combined, as I told you. So remember, I told you about the 3 candles. We're talking about the engulfing. We're talking about the hammer, and we've been talking now about morning star. Those are the 3 candles I'm giving you. And we have many. So if you need to know more about it, just take the class, click on the link, and then you will know more. Trading is a very good thing if you do it very good. It's a risk, but you got to know about it. Now, we're going to see something else. We're going to talk about how to spot market reversal with confidence. There are some signs, the key signs of market reversal. So when talking about reversal, we're talking about when this trend reverse back, whether either it can reverse up or reverse down. That's why we call key sign of market reversal. Reversal means stock can reverse down, back, and it can reverse down, up. So but there are some keys that can identify that can make that happen when the stock is identifying or going to the key reversal. So what are those keys? I'm going to tell you. We have key sign of market reversal. I'm just going to give you some idea. But in order for you to know more, you got to take a class very, because you cannot trade without get the skill whenever you get the skill, you will know more. Now, and remember, I told you that for those that have been watching or taking this live webinar, you got a good discount, and the discount has already been applied for you automatically. Now, don't take this chance. Now, the key sign of market reversals are bullish reversal. As you told you, those are the bullish engulfing. The candle that I just show you, the bullish engulfing. That's number one key reversal. Whether it start going up or going down, we call that bullish reversal. So whenever you see stock going up a certain going down, we have the bullish, whether it's bearish to bullish trend. So it's a bullish engulfing. That's the first key. The second one is the hammer, the one I just showed you, the hammer. As you know, was it the hammer? Was it the first one is the key reversal is the engulfing. The second one is the hammer. And the third one is the morning star. There are many. Now, we have the morning star. And the third thing, the fourth thing, that's give you a key reversal. So whenever you can see the trend is going down or up, whenever you see those key reversals that's been stuck can go up or down, whenever you see double top or double bottom. So whenever you see a double top, that means stock, if it was going up and you see a double top, stock has a chance to go down. So you see those double top like that. In order for you to do that, you have to take class, and stock has a chance to go down. We call that double top. So that means two candles at the same high. That's why we call double top. Whenever you see the first candle like that, and you see another candle, and they are the same high, we call that double top. So whenever you can identify the double top, you have a stock has a chance to go down. And also the double bottom, we call whenever you can identify two candles in the bottom, that's why we call it double bottom. It has to be in the bottom after stock been going down, after series going down, stock going down like that. And then you can identify two bottom, that's mean two candles, we call that two candles. Those are the two candles, they are the same high. As soon as you can identify these two bottom, the stock has a chance to move higher. Whereas, as I told you, whenever stock going after series going up, and you can identify two double top, same size, stock has a chance to go down. If you need to know more about it, to know step by step, because those things you have to teach. It's been taught. I've been taught them in a short, very clear. Take the class. I'll just give you an idea about it. Now, so you see, you need to know a lot about it in order for you to be able to trade. Now, the next one, we call it bearish reversal, bullish to bearish. We saw bearish to bullish and bearish, bullish to bearish. It's also a bearish engulfing. It's the same thing. It's just vice versa. No, you see the bullish engulfing. You can see also the bearish engulfing. So those are the key you have to identify. Those are the key signs. The bearish reversal, the bearish engulfing. You have to see the bullish engulfing for stock going up, the bearish engulfing when the stock going down. That's why we call it when we see the bullish engulfing. But we have also the bearish engulfing. The bearish engulfing, how it looks, is going to be a big red candle, like you see this green. It used to be. It's going to be a big red engulfing. We call that big red engulfing. That's a bearish one. This one is a green, is a bullish, and this one is a bearish. So that's why we call bearish engulfing. So that's why we call bearish engulfing. It's a vice versa. So a shooting star, small body with a long upper, weak, seller rejected high price. Is the same thing. We call that shooting star. How the shooting star look like? It's like that. It's big like this. It's a big, long wick like this. And then upside down, and stock close down there, and then buyer rejected down there, and it call shooting star. Or it can be for the green, it can be like that. Seller, buyer, put the price up, you're gonna vice versa. Now, and the next key you have to identify is the even star. We explain those things step by step, very clear in the class. I'm just giving you an idea. So even star is a 3 candle pattern, as I just told you to show you before, the morning star, and then we got now the even star is almost the same. So the even star, the 3 candle pattern showing the market is turning bearish. And we have the double top, as I told you, the double top here. Candles have the same size and is going down. So price tests a high price, a fall. So price going up first time, and another time price going up second time, it create what you call double top. 2 candles same size and start gonna go down. And also you have to identify those key. Also we have other key. That's why I told you have to identify them by combining them with other scenarios, like other candles, other indicators. Now we have the moving average. You have to combine them. Trend shift. We have the 200 moving average and the 50 moving average. What is the 200 moving average? Is we call that the EMA. Is a line 200, and you got the 50 EMA. So whenever you can identify the 200 and the 50 EMA, this one been teaching in the class. And also we have the golden course, which is the 50 EMA above the 200. So what is it? The 50 EMA is a line that you plot, you add to your chart. And the 200 EMA, we call that EMA, exponential moving average, you add to your chart. So this one, we call that the 50, let's say this one is the 50 moving average, and this one is the moving, the 200. So this one is the 200, and this one is a 50. So that means whenever the 50 is above the 200, that's a bullish scenario. Stock, we have a chance to go. And the key you have to identify, so we call that relative strength index, which is RSI. We have to know those things, but those things being taught step by step. We have the RSI below the 30 oversold. The RSI, how that works, it works by identifying the oversold or overbought. It's like a 2 line. You can identify them whenever the stock going up is going too high, over 70 is overbought. And the bottom is the 30. Whenever the stock is going lower, before 30 is oversold. That's why we call RSI below 30 oversold, RSI above 70 overbought. We have to identify those. Those are the key signs for you to take trade. And those things, you have to know them very well in order to make profit, to take trade. That's why we teach everything, all those things, we teach them step by step. And we have what you call the divergence with price. If price is making lower low, but RSI is making higher low, a bullish reversal is coming, and vice versa. And we have another key sign. We call it MACD. We call it momentum shift. MACD is a momentum shift. That means we have what you call the MACD line, and we have what you call the signal line. It's 2 lines. The MACD created by 2 lines. The MACD line and the signal line. So how that works, whenever the MACD line is above the signal line, stock has a chance to go high. Whenever the signal line is above the MACD line, stock has a chance to go down. We teach you everything there in this class. So take the class. And we have also the bearish reversal MACD line cross below the signal line, as I just explained to you. Now I'm going to teach you, I'm going to show you those 9 best candles. I'm just name them for you. You can see them. So whenever you see them, that means stock has a chance to go higher. Those are the best of bullish candlestick. As we told you, we have the first one. Those are the top best bullish candlestick. Whenever you can remember that, it must be. So as I put it for you there, those candles, they are very strong, they are very good, but they must be combined with others. So like indicators, like those things that those are, as I just said, those are the key. They have to be combined by those key, like moving average, golden course, depth golden course, relative strength, which is RSI. It has to be combined by MACD. They help you more. So they are very stronger when you can combine it. That's why we call those. That's why we call them key sign. So they have to be combined. The candle is not really enough for you. Some people take trade with them, but they're not really enough for you to take trade. Sometimes you need to be combine them with those key reversal here. So, but I'm gonna give you those 9 best candle bullish, and we have also the same 9 candles are the 9 best also for bearish. But I'm giving you the bullish one. The first one, as I told you, is a bullish engulfing. You see, that's a bullish engulfing. This one, those are the bullish engulfing. I'm just naming them for you because I'm gonna send you the sheet also. You can have the sheet for you, and also for those that are taking this live webinar. The second one is a hammer. As soon as you name them, you understand them. You can understand them, you can identify them. You can make profit. The third one is a morning star. These are the morning star. See, those are the morning star. That's why they put it there for you. Hammer, bullish engulfing, morning star. And we have the next one called the piercing pattern. See, the piercing pattern, this candle, where you can identify them. And we have the next one called Marabuzu. Those are the Japanese name because those candle has been created by Japanese. That's why they have the name. There's Japanese name, Marabuzu, because candles been created by Japanese. So Marabuzu, whenever you can, that's a full body of green candle, no wick. See, there's no wick. It's a full one. That's why we call it. There's no wick. There's no wick at the top, nor at the bottom. So it's creating a full body. We call it Marabuzu. If you can have, it's a full body of candle. Whenever you can identify that this candle in a short, start going to go up. The next one, we call it the 3 white soldiers. That's why they call them soldiers, because they are very active. See? The first one, the second one, the third one. The 3, we call it 3 white soldiers. If you can identify those 3 white soldiers in the uptrend, we call that uptrend. As soon as you see them in the uptrend, stock has a chance to move higher. We call it 3 white soldiers. Now, we got the next one, which is the 7th one, bullish arami. Those are the name of Japanese. Bullish arami. Whenever you can see after the big red candle, you see the bullish arami. See, small wick and small wick at the top and small wick at the bottom. We call it arami. So bullish arami, that means stock has a chance to move higher. And the next one called inverted hammer. So it's an upside down green candle. It has to be green. So that's mean empty body. We see empty body here. Create a wick. We call that wick. And then give you a small body at the bottom. We call it invert hammer. And after a series of down, and you see the invert hammer, stock has chance to move higher. And the last one I'm going to teach you, there are plenty, but I'm giving you those are 9 best one. We call that the tweezer bottom. You see, the reason that they call them tweezer, because they are the same. You see, the same high, same wick. See, those are tweezer. Whenever you can identify them with the red, after you see the red tweezer, add with a green tweezer. So as soon as you can identify those 2 together in a short, and then stock has a chance to move higher. So remember that: bullish engulfing, hammer, morning star, piercing pattern, Marabuzu, 3 white soldiers, a bullish arami, inverted hammer, and tweezer bottom. Those are 9 best. You can put the sheet. I will send you the sheet so you can put it and you can have it for yourself. Now, and then the key market structure volume clues, as I just told you, we have what's called the overbought and oversold. If you can identify these in the stock market, the key market structure volume is support, resistance, break. If price bounce off support, we have in the stock market what you call resistance. That's what I've been told you. And you are what you call support. Yes. So whenever the price, like they said, if price bounces off support, so as the candle move back down, the price move back down to the support, it has a chance to move higher multiple times. So it has to be, sometimes it has to be multiple times. the best time has to be 3 times. Sometimes it can be 2 times. Price move, go high and move back down with high one and move back down second time and move back again and then go down the third time. So after 1, 2, 3 times, that's called multiple time, stock has chance to move higher. So if what reject a resistance level 2, we call that about the support. Now, for the resistance price, if price now reject, as I told you, if price reject a resistance level, a bearish reversal is forming. So for instance, price moving up, and then it create a resistance here. First candle, reject and go back down and move back again. Create another candle here. That's second, that's first, that's second. And then go back down and move down again and create another candlestick. 1, 2, 3. We call that resistance. At the resistance, stock has a chance to move down. Support 3 times, go up. Resistance 3 times, going down. So that's the way. We have what's called the trend line, which is the trend line breaks. The trend line breaks if an uptrend line is booking downtrend, if possible, a bearish reversal. If a downtrend line is booking upward, if signal a bullish reversal. So we have what's called a volume confirmation. If price reverse with high volume, the reversal is stronger. For instance, whenever you see a reversal, like you see the 3 times, went up to that resistance, 3 times, that's 1 time, second, went back 3rd time. But you see the volume is like that in the bottom. Those are the volume. And the volume is very strong, like volume is very high. The reversal is very strong. But now, if the volume is not too strong, the volume is a little bit small, so can be a fake out. That means it might not be going down. It might be a fake, and after that, it's going up. But the volume will help you to identify if it's a strong reversal, because the volume has to be high, very high volume. If you see high volume, the reversal is strong, is good. But if you see small volume, the fake out is a fake out. Those are the things we explain very well and give you very identifiable and very clear in a short step by step to identify them. And also, we have what you call best strategy to trade market reversal. As I told you, the best thing you can do, you see, that's a bull candle, which is the green, and you have the bear candle, you see, which is this one. But how you identify the key? So we have to wait. Sometimes, even though you see the big candle, which is the hammer, or you see any big candle, but you have to wait for confirmation. That's what I want you to do. Don't just enter based on one candle. Remember, I told you we have the hammer, big hammer. We have the tweezer. Every time you see those candles, we have the engulfing. They are not really enough for you to take a trade. Sometimes you have to wait for confirmation. It has to be confirmed. So how you confirm it, as I told you, by key level. For instance, support or resistance, or you can wait for RSI or moving average, or you can use the moving average, which is the 50, the 20, and the 9. So, but the best thing to take a trade is by using your stop loss order. So sometimes if you're not sure about it, it's always best to use what we call stop loss. We teach you that step by step in the class. So you place the stop below the support. For instance, that's a support. For instance, this one is support here. That's a support here. You place your stop loss below the support. So if you buy, for instance, if you buy there, let's say you buy the stock here, you take profit here. Let's say you take profit here, but you place your support below the support. You don't put your support there. Your stop loss. You put the stop loss. You call that ST. You put your stop loss below the support here. By there in the middle, profit target. We call that profit target at the resistance, and your support your below your support, you put your stop loss. That's the technique, that's the strategy you can do to be trade like that. We call that use a stop loss or the place stop loss below for bullish reversal and above resistance to bearish. So if it was bearish, you put your stop loss above here. You trade with risk management. You keep risk reward ratio at 1.2 or higher. So the only thing you can look also, we call that look for divergences if price and indicators disagree. How price and indicators can be disagree. I'm gonna tell you something very fast. For instance, you have the big, let's say you have the big engulfing candle. We call that the big engulfing. But you have the moving average. Remember, the moving average, we have the 50 moving average line, and you have the 200 moving average line. But that the 200 moving average line. So how price can be look for divergence, or price indicators can be disagree. So remember, whenever you have the big engulfing candles, that's good enough because it's good for bullish, but it can be disagreed by the moving average. For instance, the 50 moving average, remember, the 50 moving average, which is the small number, has to be above the 200. Whenever the small number is above, which is the moving average, above the 200 stock is strong. But they can be disagreed by if now the 200 is above, the 50, and even though you still have the big green engulfing candle, they've been disagree. So you have a chance for the stock to be fake out and go bow down. The way it can be strong, the big candle or the hammer, whatever you call it, sitting on the support, and the 50 or the 200 has to be agree. So the 15, which is the small number, has to be above 200, and you have also the hammer candle sitting at support. That means we call that a strong buy. You call, because the small number 50 has to be above the 200, and plus the hammer candles has to be sitting at the support. We have that, we call it strong. That's why we call it disagree if they're not above like that. So would you like to know more about it? Click on the link that I will put there for you, and you'll know more of them. Last thing I'm going to teach you today, we call that pro trading strategies for consistent profit. Because I told you I'm going to just teach you. That's what I've been teaching you today. Whenever I say I'm going to do something, I do it. I don't take time to do advertising. I just teach you and take you time. That's why if you take this class, you will know more. You know, the best thing about this class that I will put there for you is very cheap with great discount. We teach you all those things there. Here we give you details, but we teach you step by step. We take your hand. It's like you are a baby. We take your hand to teach you things step by step. And the best thing about it, you have this class forever. This is not something you just have and then you don't know. You can review it, come back to it, and whenever you not understand something, you come back to the class and you take it again. This is the best thing about it. So it's very cheap for you today. So the last thing I'm going to teach you is what you call trading strategy for consistent profit. So when it says consistent profit, that means if you use this strategy, you will always make profit. That's what we call consistent. Now, to be consistently profitable, pro traders use a combination of technical analysis, as I just do. What they combine? They combine what you call, first thing, risk management. So what is a risk management? A risk management is like you have $1,000. You don't trade all of them at once. You put 10% for the first trade, and you can put another 10% for the next trade. You can put even less, 7%, or you can put 15%. But you put them by risk. You risk them. So we teach you everything by them. And what you call the next one is psychology. The stock market, what you call psychology. We teach you that in the class. What is the psychology? The way you study the market. You don't go on the market like that. You study it. You don't. That's what we call psychology. Stock market. We have what you call the psychology of market. We teach you all those things. And below are some of the best strategies to help you with trade. Those are the things I just told you about it. you have to identify the trend using the 50 EMA. Which is what is the 50 EMA? If it is you understand what is the 50 EMA, a 200 EMA called exponential moving average. That's what it means. It's exponential moving average. 50 EMA. So the 50, that's a line we plot on the chart, we call 50. And there's another line we plot in the chart, we call 200. So remember, the small number has to be above the big number for that to be bullish. Whenever the big number, which is 200, cross above the 50, stock is going down, is bearish. So which is to that everything. We have the downtrend price below 50 EMA, as I just told you, it's already been explained. 50 above EMA, above 200, that's a bearish. 50 above 200, that's a bullish. Now the 50 below the 200 is a bearish. And then you have what you call enter on a pullback, wait for price to touch the 50 EMA. Sometimes we have the price 50 EMA here, like I told you. The 50 line, you wait the candle to touch it. That's a candle. Whenever the price is going up, you have to go back to that. We call that. And remember, in the class we teach also the 50 moving average, we present what you call support. So whenever the price is going up and it's going back, it touch the 50 moving average, it has to go, it has a chance to bounce back up. That's why we call it touch, wait for the price to touch the 50 moving from a bullish or bearish. It can be at the top, if the 50 moving average like that, and the price moving up and it's touched the resistance there, it has a chance to go back down. It's the same thing with BCVSR. Now, you use RSI, the 30 for oversold 70. 70 means stock is overbought. 30 means stock oversold. We teach you all those things. You take profit at previous high low. We teach you how to take profit at the previous high low, or we call what you call the Fibonacci extension level. The Fibonacci extension level is a thing that we add to the chart, and it has level. So we teach you everything. Again, we have example. If price is an uptrend, wait for pullback, 50 EMA, look for bullish, engulfing, or hammer. So whenever you see price go down, price going up, and it reverses back to the 50 moving average or support, so you don't just buy, you wait for confirmation. So how you wait for confirmation? You wait for a bullish engulfing. As soon as you see a bullish engulfing candlestick, you can buy. Or you can see a hammer. As soon as you see a hammer, you can buy. That's why you call confirm, even though the price is touching the 50 moving average or the support. So my friend, it was a very good pleasure to be with you today. I think we give you more than 30 minutes. We give you a step-by-step how to trade, what you need to do. All those things, you need to know them step-by-step in order for you to make profit, in order for you to trade. So if you have loved this class, please let me know, send me an email, and then I will send you the link for the class. And for those you already been there, you will take this class that I teach you very, very step-by-step, teach you everything. You already have your discount since you already been participating. You're gonna see all those things and more than that for a cheaper price. Take the class. And it was a pleasure to be with you today. It was Harry. So thank you. Bye-bye. And we